Okay, well, we now have some more assumptions of the budget, the macro assumptions, and I want to toss them to the economist, both K.V. Subramaniam and Sajid Chinoy, who's with us. Sajid, the assumption of nominal GDP growth is only 10.5. So it is, okay, we don't have, okay, we should get to Sajid in just a minute. So it's only 10.5. You know, there were expectations that they could assume 11% growth, but only assuming a 10.5% growth in nominal GDP, still the tax growth assumption is only 11.9. That works out to about a 1.2%, 1.2 times tax buoyancy, which, going by the performance of the current year where tax buoyancy is almost 1.4, this is an extremely conservative assumption. Another conservative assumption is that current year they have collected far more taxes in the first 10 months, and yet the revised number is not revised higher. It is revised lower by a few rupees only. It was 23.30 lakh crore. They've actually revised it down to 23.27 something. So the point is that the base can be revised higher. The actuals will be higher unless you assume a real fall in taxes in the fourth quarter, which is no one's base assumption. So if the revision is higher, then actually they're assuming even lower tax revenues, which explains perhaps this buoyancy in the bond market. They may not even borrow 14 lakh crore gross and 11 lakh crore net, so it seems. Mr. Khara, you think that there is a big Diwali waiting to happen in the bond market? You're going to have a lot of mark-to-market gains?
Yeah, it should be there, but I think apart from this, immediate reaction, I think on an ongoing basis also, it should actually moderate a little more, and which will actually push the interest rate regime also towards the lower side. So I think this is a welcome development, particularly for a developing economy like us. This means quite a lot.
Yeah, I'm going to come back to all of you and to the former CEA on the macro numbers. Just hold on for a minute, gentlemen. We have to address the stock markets as well, and Prashant Khemka has joined us. Prashant, what do you make of what is an excellent macro budget, but no details in terms of, you know, a transfer of incomes to the lower classes, which was what was one of the expectations? First, your overall comment.
No, thank you, Latha. I think overall it's a good budget, a budget of continuity. Over the last several budgets, particularly the last budget, was very well received by the market and investors at large. So continuing the policies of the prior budget is again a positive. There's no major negative in the budget. That's always a positive in itself. There were some concerns of it being a pre-election populist budget that hasn't played out. In fact, as you highlighted very much, the most significant positive of this budget is the budget fiscal deficit estimate of 5.1%. Yeah, so the concerns on populistic budget has been dispelled. At the same time, the capital expenditure outlay has been increased by double digits on back of a 33% jump last year. So within a span of 2 years, a 50% jump in capital outlay that goes a long way to towards building the capital stock or the infrastructure stock of the country. So for an interim budget, I think in 3 succinct points, I would say it's a budget of continuity with big positive in fiscal deficit, at the same time increasing the capital outlay.
All right. Okay. I want to get a word on stock market. Sorry.
Yeah, sorry, please.
Ramdev, to you. See, there are two positives. The immediate positive for people like Mr. Dinesh Khara, the mark-to-market gains on bond holdings. So those kinds of stocks are doing well. But basically, if the government is going to pay only 7.07% now, 10 basis point fall in the 10-year benchmark paper, if the government cost of capital is falling, won't it also mean fall in the cost of capital for corporates? So, do you see EPS gains, other kinds of gains for corporates? Your thoughts?
Yeah, so when the interest rate tends to go down and the global environment is also for softening of the interest rate, in that case, the attractiveness of the fixed income vis-a-vis equity markets, that equation further tilts in favor of equity markets. And then if the cost of borrowing for the corporates are lower, the operating leverage will tend to work, financial leverage will tend to work, and for a given growth at EBITDA level, I think the net profit growth will be a little higher. So higher profit growth lower cost of money, so a higher multiple, I think that should be directionally positive for the equity markets.
By the way, another pack which should benefit is life insurance companies. I mean, in terms of the fallen yield, mark to market. I mean, I think life insurance, I'm not sure if there's a reaction or not, but that's another pack worth watching. Ramdeo, how much of this is priced in? That's the question, right? The government over the last so many years has opened up so many sectors. Railways has become pretty big now in terms of, they talked about converting 40,000 wagons into Vande Bharat. So 16 bogies a train, that's about 2,500 trains. I mean, if you go by what we have so far. But I think 1,000 trains the government has already spoken about over the next couple of years. We have about 40 right now. So it's a big program. Maybe that's has been expanded. We'll have to check. Defense is another area there was some focus on. But the point is, markets price a lot of this ahead, right? So how much of all of this is in the price in that sense?
Yeah, so actually in this budget there's no specific provisions, at least not in the budget speech. In the papers there might be some further detail, but since the government has not expanded that big because of fiscal consolidation, there I think total budget expansion is only 5-6%. So in that situation, I think almost like a status quo kind of situation, that whatever happened last year in the name of capex, I think capex is more or less just about 1 lakh crore higher or something like that, from 12.5 lakh crores to 13.5 lakh crores, something like that. So I don't see, and for the 12.5 lakh crores, market is clearly aligned. So I don't see too much of surprises for the markets from that allocation point of view. So they are fully priced. I mean, fully into the budget speech per se has not given any surprise. So today is the day of surprise, and surprise has come from the fiscal deficit number for the 24-25. So I would think that it is more to do with the banks. Particularly banks they have been underperforming for last 12 months or so. So I think this might be the turn of this. It's a very large sector. It's almost like the largest profit pool and almost 30% of the market. So if that turns around, you can imagine what it can do.
Yeah, absolutely. The top gains, if you take the CNX 100, Bank of India up 3%, Union Bank up 2.6%, Bank of Baroda up 2%, Canara Bank, Axis, HDFC Bank. I mean, it's the banks who are up and away because of this big gain they will have in their mark-to-market. What you say, Ramdev, about the infrastructure stocks is well taken. I think the market was running away with the expectations that there could be a 20% rise in the capex bill. It is more like a 11% rise in the capex bill. As Ramdev pointed out, it's more like 11.1 lakh crore, the central government's own expenditure. Plus, if you take the PSUs, it comes to about 13.5, as you pointed out. It's more or less in line with expectation, and therefore L&T has reduced its losses from, I think it was -4%, it's now come down to -2% in terms of the stock performance. But I think it's in the price that the capex will benefit them.
I think also the railway stocks, right? All the railway stocks are under pressure right now and selling off quite a bit, IRFC, etc. The railway capex as well was expected to perhaps be much higher, considering that the expenditure in railways has been the highest in year to date. But that didn't come through. It was slightly lower than expectation. So we're seeing a little bit of profit.
Another such a bumper. You had all those stocks running up 130%, 150%. So now I think it's the day of reckoning.
So this is the interim budget. July we'll get the full budget. Is there a chance we'll get wildly different numbers in July? Or what's the tradition, I mean, here? From the interim to the actual budget?
Historically, numbers have been quite consistent between the interim and the final budget.
Wow.
So you will probably get more of the same. I mean, you will get more granular detail, you will get specific tax cuts or announcements. My own sense is that if the market and general economy continues to perform as well as it has through till July, you probably can see a watershed budget again in July. I mean, I would think, given the first year, given where the economy is, given that even this budget seems to have been well accepted by the market. And I think, Latha, the point you made most important. We are completely underestimating the tax collections. We think we will come up significantly higher, and that's really what the bond market is really elated about, because that higher collection effectively means much lower borrowing by the government.
Mr. Kanabar, you wanted to come in, please.
2 points. One is, as Ashok rightly mentioned, generally the final budget really it takes on from this. But given that, assume for a moment that this government is back in power, there will be the first budget they will present for the next 5 years. So I would see a lot of policy changes really come about, and new announcements, new policies, etc. And of course, a lot of tax things. Here we have seen nothing. But normally in any budget, you would see at least anywhere between 60 and 150 changes. So there is nothing here. So all that is for the shape of things to come. And Latha, you were mentioning, a small little point regarding those tax write-offs. Very interesting, nothing really earth-shattering. But for the government to come back and say that if there are old dues right up to 2009 of 25,000 rupees a year, we are unable to trace those people, just carrying forward write-off, and then beyond 2009 to 2014, 10,000 rupees write-off. What will do is to clean government's books. Today, the amount due to what is collected is a very poor ratio. It will just improve that ratio.
I think the focus on the budget is it's a very business-like budget.
Yeah.
That's to me comes as the word. It's a very business-like budget telling us that I'm getting into a new era of next 5 years, and this next 5 years is going to be very different and very business-like.
Exactly. I think we should get the economists in. Dr. Singh and Dr. Subramanian have been waiting by patiently. First to you, Dr. Subramanian, the numbers, I mean, the assumption is only 10.5%. Okay, that is a conservative. And then you have a conservative tax assumption of 11.9%, which I think is conservative considering that this year we have done well. It's also conservative because this year's number has not been revised higher. If you look at the year-to-date available numbers, taxes have grown by about 14.5%, taking direct and indirect. And the assumption was 11. So they have not revised that higher. So we must expect higher taxes. I mean, your comments on all this, very conservative assumptions, you would say?
So, Latha, I think this has been part of the trend. If you've seen the budgets in the previous years, starting from the COVID budget, it has been a case of under-promising and over-delivering. If you look at this year's, the target was 5.9% fiscal deficit, and what has been delivered is 5.8%. Now, to come to the assumptions, I actually think that the 10.5% growth number, nominal growth number itself is quite conservative. The reason I say that is if you take real growth to be 7% and the GDP deflator to be 4%, which I think should be reasonable given, the WPI, the huge increase 2 years back and then the negative territory last year. The median of 4% deflator, I think, is reasonable to expect. That translates into a nominal growth of 11.3%. Now, I want to make a small correction. The tax buoyancy that is assumed here for a tax growth of revenue growth of 11.9% is actually 1.13. I think that's very conservative given that if we look at the tax buoyancy has been 1.6 this year, and I've looked at, over the last decade itself, it has been between 1.5 to 1.6. So a tax buoyancy of 1.2 is very reasonable to expect. So my sense is that once again, we will have nominal growth about 11.3%, and actual tax or overall revenue growth will be closer to 13.5%, assuming tax buoyancy of 1.2. So again, I think that 5.1% number that has been promised for FY25, my sense is that we may be actually seeing 5% or 4.9% come next year, unless there is a drastic change in the budget that is presented in July. If you just go by the numbers right now, I think it's again a case of under-promising and over-delivering, on the fiscal front in the coming year as well.
Okay, and that's always a good thing, right, from a market standpoint as well. By the way, the market has not moved an inch. It is absolutely flat. I guess it's a very mature reaction because nobody expected too many things to come out of the interim budget. We have Suneeta Reddy, who's also joining into the discussion. She's the MD of Apollo Hospitals. Suneeta, welcome to the panel. I'll just come to you in a bit. We have Dr. Singh as well, who's been sitting by waiting patiently. Dr. Singh, your views, how would you rate this budget on a scale of 1 to 10? And what do you think is the biggest takeaway, apart from, of course, what we spoke about, which is fiscal profligacy?
Well, let me say this, that I don't want to get into this arithmetic of 1 to 10 business, but I rate this budget as an outstanding response, looking at the impending elections, staying away and steering away from a path of any kind of a suggestion of fiscal profligacy or making it populist, a great degree of confidence that the achievements already speak for themselves. You do not really have to add to that, and a great confidence of what they will do in July. I think few governments which go into an election in the next few months exude this kind of a confidence, in the interim budget. This is the 14th interim budget from the inception of our budgetary process, and very few interim budgets have reflected this kind of a confidence. This is one. Second, I fully agree that this is a case of overperforming and under-promising. I think this has been done more than once, and I think that this is based again on the fact of an assurance of continuity in the growth story. I think that definitely both on the real GDP and on the deflator, there may be some room, and I think this is, if anything, really a conservative estimate of 10.5. It will definitely be better. On the revenue, looking at the performance in the last 1 or 2 years, definitely these buoyancy numbers are on the conservative side. As I said, that the GST is improving every month, and this is notwithstanding the fact that we have abstained from making deep rate rationalization, because in the case of GST, there is a very credible case that the GST rates need to be rationalized further, which will give a new fillip on the GST buoyancy numbers. So I fully agree that this is a case of under-promising in the expectation that it would be more than realized in the full budget is coming. This is yet another demonstration of the renewed confidence and the renewed expectations that the government has on returning to power and returning to office without a shadow of doubt.
Take your point, sir, that they don't even need the prop of unwarranted populist measures or giveaways. That confidence is demonstrated, and that political stability is something which the market will take home. At the moment, of course, in the grip of the FOMC announcement and a 1% fall or almost a 2% fall in US markets. So perhaps the reaction is slow to come now. There are more position adjustments. But I just want to make one more math before I come to you, Suneeta Reddy. The tax to date, that is April to December tax collection, is higher by 14.3. And the assumption of the revised estimates is only 10.7. Now, one would assume that they will assume at least a 14% growth in the full year. They have not taken that assumption in the current year. They've taken a lower base. So that is why I think that there are two good reasons why this year the fiscal deficit is absolutely much lower than what even the numbers that the budget is reflecting at this point in time. They are going to make much more money on taxes. Well, with that, let me invite Suneeta Reddy to the conversation. Ma'am, thank you very much for your patience and your first takeaway from the budget.
Thank you. I think all the economists on the panel have spoken about healthy economy, growth, and a very good movement in terms of fiscal deficit coming down from 5.6 to 5.1%. So let me talk about the source of growth, which is the focus on women and maternal health, which I think is very much needed. Cervical vaccination for women, for children from the age from 9 to 14. The fact that we are going to add more medical colleges and therefore get more women into the workforce. And I think overall the focus on women and childcare is something that is going to increase the number of women coming into the workforce. What has really excited us at Apollo is the amount, 1 lakh crore amount kept for research and innovation, which will hugely benefit research, clinical outcomes. And this is interest-free loans for a period of 50 years. So long-term guarantee of better clinical outcomes for the country. And I'm sure that, with this leverage, we will be able to do much more for the country as well as attract international patients to India.
Right.
Okay. That point is well taken. A stable macro and unchanging tax regime, a stable tax regime should be very big attractions. But more importantly, I think it's the macros that usually attract outsiders. Mr. Khemka, what do you say for this? It looks like the cost of capital for corporates in general is likely to fall because the government borrowing rate yield has fallen. How do you approach the market now? Will banks be your favorite because they make money on their bond book? or will it be across the board corporates because the cost of capital falls?
Certainly. So, see, the banks, particularly the PSU banks and those with big bond portfolios, would benefit to the extent of the treasury gains. But otherwise, on the whole, there were not dramatically different expectations from the budget, given that it was budget of continuity. As we already talked about in case of infrastructure, despite a double-digit jump in the interim budget to the layout, still the infrastructure stocks aren't really reacting, positively. So it's the case of a company where if expectations are already very high, even if the company delivers on a high note and delivers what was expected, the stocks might not react positively. So the outcome in that the market is reflecting today is not surprising in that case. So not any particular sector that I would say which stands to materially benefit over and beyond was what was already factored in at this point, and all the eyes would now be on the July budget, Latha.
Would you be a BFSI bull now? I mean, if you were, I don't know if you were.
So we tend to structurally have much higher allocation to financials, particularly the banking and also the NBFCs, and we continue to be in that position at this time as well.
Dinesh Khara is listening to you. As you say, the banking sector already, most investors bullish on that segment. If we can get KV Subramaniam in again. Dr. Subramanian, like I've been saying, the assumption of tax collection for the current year is far lower than the demonstrated collection in the first 9 months. The first 9 months growth is 14.3. The budget is assuming a 10.7 growth. I mean, way lower than what has already been demonstrated. What is the usual practice? Will they revise higher in July?
So actually, that is what I expect. The 5.8% fiscal deficit number that the Honorable Finance Minister mentioned for this year, my sense is when the revised estimates will come, it'll be lower than that. So I think the actual fiscal consolidation path will be even stronger than what has been spoken in the numbers that the Honorable Finance Minister mentioned. I actually will mention, you would recall, Latha, that there was a break from the past that was done when off-balance sheet items would be hidden, there would be no transparency. From there, actually, to put everything upfront transparently and to be conservative in projections has been, these have been two key changes that have happened in the last few years, and this is a continuation of that, I think, which is an excellent, in general, I'm someone who actually likes governance to be one where you under-promise and over-deliver. And I think emerging out of COVID, that kind of fiscal math, I think, will give a lot of credibility. And hopefully the rating agencies are paying attention. I had written about it when I was in office as a CA. My successor has written about it as well. I think it is absolutely high time that the sovereign rating agencies look at actually their models and modify the rating. The current rating makes absolutely no sense, in my opinion, given how credibly the government has been delivering on the fiscal numbers.
No, absolutely. And point taken, sir. By the way, just a quick look at the insurance companies. I think that is the only sort of pack of stocks which is moving on the back of what's been announced. And it's an indirect move, apart from, of course, what's happening with banking and financial services. Look at SBI Life, look at ICICI Pru, look at HDFC Life. Most of these stocks are about 4-5% off the lows from before the budget speech started. Last time, remember, for insurance companies, there was a fair bit of negative and stocks sold off. This time there is no negative, and at the margin, perhaps, bond portfolios benefit. Mr. Dinesh Kumar Khara is still with us.
Just a word on the banks.
Yeah.
Prashant, of course, please go to Mr. Khara. But he would also like to hear, now the bank Nifty itself is up 0.6. And the public sector banks are like absolutely going through the roof. UCO Bank is up 4.6, Union Bank 4.5, Bank of India 4.3, PNB 4.2, Central Bank 4.2, Canada nearly 4%, 3.7, Bank of Baroda 3%. I mean, it's like huge. State Bank, the mighty giant, which has already been rising, up 1.5%.
And not that they needed any particular help, because they've been doing so well over the last so many months now. Mr. Khara, you run a fairly sort of large insurance subsidiary, one of the largest insurance companies in the country. Is there a significant impact because of bond yields falling for insurers, life insurers as well?
Yeah, that will also impact them. But the fact of the matter is that what you mentioned about the last budget, there were some kind of restrictions which were imposed in terms of the tax relief for buying insurance beyond a particular threshold. So that was the reason why they had seen some kind of a dip. But this time, see, overall, when the investment market becomes positive, insurance has got a lot of income which flows through the investment portfolios. So that will certainly be of advantage to them. And in any case, all of them have got a reasonably decent ULIP portfolio. So in the ULIP, when it comes to this debt market instruments and falling interest rate will certainly be to their advantage. So that is the other reason why they can create more value for their insured customers.
Got it. All right. We have Nilesh Shah of Kotak who's joining us into this discussion now. Nilesh, I'll come to you in a bit. I have Sajid Chinoy who's also waiting by. So before we come to you, let me just get a final word in from Sajid. Sajid, there are no SOPs or big rural transfers that were announced this time around. So some of these FMCG stocks have come under a bit of pressure. But I guess it's good to see that there are no major populist measures despite it being a pre-election budget. What is your take on how things on the rural side are going to shape up? Because clearly this has been a pocket that has struggled at least for the last 4 to 5 months. Do you expect something big to come through in the main budget in July?
I was just saying earlier, I think the effectiveness of policy is to be counter-cyclical. And I think what today's budget has done is to demonstrate that counter-cyclicality is symmetrical. I think the need of the hour was to bring the deficits down, given where starting points were. The need of the hour was to ensure that capital expenditure was not withdrawn. So we've seen that maintained as a share of GDP. And of course, the welfare support will need to be targeted. Now, just a couple of quick clarifications. Latha had brought this up. If you look at gross tax to GDP, that has been budgeted much higher in the RE compared to the BE. But net taxes are lower because the transfer to the states is higher. So we have to be cognizant of that. Number one. And number two, for next year, the accounting is conservative. Nominal GDP of 10.5, one should expect a buoyancy of higher than 1.1. What that will do is let the deficit be consolidated more on the revenue side than the expenditure side. Currently, if you look at next year's B, most consolidation is on revenue expenditures, which from a quality of expenditure perspective is good. But if you do end up getting more tax buoyancy, and I've been harping on the asset sales for a long time. If in the July budget there's a focus on asset sales, then essentially you can get more consolidation on the revenue side and protect expenditures even further. But the accounting in general has been very conservative, and the need of the hour was just to double down on a fiscal consolidation path, which I think this budget has done very effectively without compromising capital expenditures.
All right. Well, in fact, Nilesh Shah is also joining in. So let me get his thoughts in. Nilesh, as Sajid was saying, the need of the hour is to double down on fiscal consolidation. And that's pretty much what the government has done. You think it's a win-win situation from here on? And from a market standpoint, is there anything in the budget that can help the market see incremental gains?
So one, the fiscal consolidation path given by the budget is way ahead of the street. No one was expecting 5.1% fiscal deficit. Hopefully that will give confidence to the market. Second, on infrastructure allocation, there was fear that this year maybe the allocation will not be enhanced as much. 11.11 lakh crore on the revised estimate of 9.5 lakh crore is a 17% jump. That's fairly positive. And overall, clearly, our economy today faces two challenges. One, consumption at the bottom end of pyramid is not growing as fast as the top of the pyramid. And private sector capex is not growing as fast as the government capex. In this budget, at least there is supply side availability for private sector capex. Net borrowing program aided by debt FPI flows will leave enough credit in the banking system and market for private capex. And some of the steps announced on housing, fisheries, agriculture will hopefully support consumption at the bottom end of the pyramid. It will be fair to say that markets will be satisfied with the vote on account. as it achieves the impossible trinity of creating inclusive growth, spending on infrastructure for future, and yet maintaining path of fiscal prudence.
Well, I must point out to Dr. Subramaniam, to Sajid, to Nilesh, you as well. The amount of bonds that are getting redeemed this year is 2.7 lakh crore. When I say this year, I mean FY25. So we were expecting a 2.7 lakh crore difference between gross and net borrowing. It's actually the difference is only about 1.2 lakh crore. What I understand is the entire compensation, GST compensation cess, is being used to redeem those bonds. So the difference between gross and net is not the assumed 2.7 lakh crore. It's much less. It's half of that. The other half is being taken from the compensation cess fund of the GST. That's just by way of information. We are getting it as we read the fine print. So net. Yeah, go ahead, Nilesh. Yeah.
Latha, there is also possibility that there will be a switch between government and the RBI in the days to come. And that would reduce the net borrowing program probably.
No, the switches have been announced at 1 lakh crore. That is also there. But I think this is separate from that, and that explains why the borrowing is so attractive for the market that you're seeing the bond prices jump, because they are not going to borrow from the market, but adjust it from the compensation cess. Suneeta, Reddy, if the cost of capital falls, do you see that as an attraction for investment? Already, hospital chains and healthcare is a burgeoning sector. Do you think if the cost of capital falls, cost of money falls, that is a very big, injection, fuel injection for you all?
Yes, certainly. I think that especially at Apollo hospitals, where we're looking at adding over 5,000 beds, the cost of capital is key, and it will bring down the cost per bed, and therefore I think the whole country will benefit from this, and our sector especially.
Yeah, Prashant Khemka is also with us. Prashant, afternoon. I'm sure your team must also be feeding you information in terms of what they are doing as the speech comes through. Although it's an interim budget, it was a short. Anything actionable which you've kind of discovered? I know you're not a very short-term kind of a sort of a person in that sense, and how you operate the fund, but anything strikes you across sectors?
Well, thanks, Prashant, for the question, but nothing really exciting necessarily from the budget that would prompt any action. I think we do spend time analyzing and understanding what the longer-term direction of the policy is, and what we've discussed so far is that it's a continuation of what was laid out last year and what has been the direction over the last 10 years. So that in itself is a big positive and would be very well taken by investors, particularly the global investors. Nothing in the budget that negatively surprises, and it's the message of continuity, which is a very good message.
Okay, Prashant, will you all be positive on the public sector stocks, the ones that already ran up a goodish bit, but is there any juice left in any of them?
So again, see, in a portfolio that is constructed with in a manner that doesn't necessarily trade in and out on a daily basis, 2-3% move is not something that would prompt action. As I was saying earlier, BFSI, which is the most significant beneficiary of the most significant positive of this budget, which is the fiscal deficit estimate coming at 5.1, that it's already is a very big, the largest allocation in our portfolio. Structurally, it has been the largest allocation in the portfolio. So in a way, we find ourselves in a position that we might have brought ourselves into if we weren't already there. So as a result, there's nothing that we believe at this time, at this point, on an incremental basis, we need to do.
So we are itching to go to the CII because they will be, best placed to say what they can do with the cheaper cost of capital. But Shireen, before I come to you, just one word from Nilesh Shah. Nilesh, does this make debt attractive? Debt was the stepchild, debt mutual fund was the stepchild of the previous budget. Now with bond prices rising, is there a macro-oriented positivity in debt funds?
So undoubtedly, there will be some catalyst, but we still need to deepen our bond market. It's a work in progress for long. And debt mutual fund to grow will also require some sort of support or level playing field. Today, if you invest in NPS and you are a salaried employee, you get 10% tax exemption. You get tax exemption up to 10% of your salary. At the highest slab, that's 3.9% incentive. In insurance, some tax concessions have gone, but below 2,50,000 rupees, there is a tax incentive. So debt market will need to be dipping, and debt mutual fund will require level playing field before investors actually start allocating to debt mutual fund.
Absolutely. And easing bond yields should also give some relief to borrowers, right? Home loans, personal loans, etc., which will eventually lead to higher disposable income for individuals. So that's a positive as well. Thank you for that. But let's toss it across to Shireen now. Shireen, back to you.